Well, speaking of the Fed, our next guest says the Fed right now is facing stress in both of its mandates. Here with how that will affect the markets is Skyler Weinand, Chief Investment Officer at Regan Capital. The firm has about $3.6 billion in assets under management. Skyler joins us from Dallas. I want to start with that dual mandate and kind of kick off with really leave off with what Enda was talking about there. We're kind of working and still working with incomplete data thanks to that government shutdown. But which of the Fed's dual mandate right now do you think is more stressed?
Definitely employment. They're concerned about employment ticking up even 10, 20 basis points, which might make them cut again here in late January. But we get that number next Friday. We get the jobs number next Friday. We get CPI right after that. And lest we forget, Governor Moran's term is up at the end of this month. So if Trump's going to do something, it's likely going to happen fairly shortly. He only has 29 days left in his term to either get replaced, reconfirmed, and we might hear that Fed chair announcement as soon as, next 10 days or so.
So does that mean that Fed Chair Jay Powell is a lame duck at this point?
Pretty much. It's we have this foggy data, especially that CPI data. It was a crazy report with all these zeros. Hopefully, when we get that report in about 2 weeks from now, it's actually filled out. And that affects a lot of things. It affects 10-year treasuries. It affects inflation-protected instruments out there. It affects Social Security, cost of living adjustments. So we're talking about that shady data having some real-world effects, which is a problem. But we are going to get some real data here next Friday and then the week after that with jobs and inflation. But I suspect, the Fed is live here in January and potentially February if unemployment picks up 10, 20 basis points and heads towards that 5% number. They're pretty nervous about that. But I think they're going to look back at this period in time and say, hey, we may have actually cut too much because inflation might rear its ugly head again come, this spring and this summer. Inflation gets back up to 3 to 4%. Chairman Powell's out. He's on the beach. And the new Fed chair steps in, starts to cut rates again. We're going to start to see some issues on Main Street, some revolts over higher prices this year.
Hey, what do you make of, Skyler, in a year where we saw equities rally for the third year in a row, strong gains, more than 20% here in terms if you look on average annually, quite a bump up. And at the same time, you saw treasuries gaining the most since 2020. It's not typically the trade that we see. So do we get more normal in 2026? And what does that mean? Does that mean equities go down and treasuries go up in 2026? I'm just curious how you make sense of that relationship.
Yeah, last year was a great year. It's going to be extremely hard to repeat that, but I do think we're actually going to get close. I think a lot of that equity movement was based on really strong earnings, multiple expansion. PE only went up, 1 to 2. So it wasn't as much expansion as it was really strong earnings. And then on the bonds side of thing, what is looking really good right now is the curve is steepened out. So the curve, that 2s to 10s curve, effectively where folks are borrowing versus where they're lending, has become positive. It's as positive as it's been. It's at 71 basis points, as good as it's looked in 4 years now. That's really bullish for banks, private equity, real estate, anyone who's borrowing and levering up their returns. So I think equities are up 10 to 15% this year, and I think bonds actually have a relatively strong year, up 5 to 6%, not as good as last year, but I'm pretty bullish on real estate turning around and activity picking up because we're almost at 5-handle coupon mortgage rates. I was talking to folks today that are getting 5 3/4% mortgage rates without any points down. So we're there. We're going to see a fairly resurgent real estate and home building year. And I think mortgage prepayments pick up. That's also going to help a lot of these banks that are drowning in underwater mortgage bonds that they bought 4 to 5 years ago.
Hey, Skyler, just got about 30 seconds left here. Here we are, first trading day of the new year. What are you thinking might be the best investment idea and where investors should be looking to channel money as we kick off this new year? Just quickly.
Yeah, quickly on the bond side, stay short, stay floating rate. That curve's going to steep it out even more. Do not go long TLT or the 30-year Treasury right now. On the equity side, banks, JP Morgan, Goldman Sachs, Bank of America, I think they're going to have a gangbuster year on the steepening of the yield curve.
All right, going to leave it on that. Happy New Year. So good to kick it off with you, Skyler. Thank you so much. Skyler Weinand, he is Chief Investment Officer of Regan Capital, joining us. That firm, by the way, $3.6 billion in assets under management. Skyler joining us there from Dallas. We